Shareholder value, it's the cornerstone of corporate America, the raison d'etre for every publicly traded company. It is why, for example, CEOs are hired and paid millions of dollars to boost the stock price and make shareholders rich. Now, what if I told you it's a boneheaded idea that's undermining the U.S. economy and destroying the very fabric of capitalism? Well, that's the thesis of a new book by Roger Martin, Fixing the Game, Bubbles and Crashes and What Capitalism Can Learn from the NFL. Roger is Dean of the University of Toronto's Rotman School of Business. Bloomberg Business Week has called him one of the world's most influential people in the world of design, in his case business design, as well as one of the 10 most influential MBA professors. Roger is right here in the Inside Track. Roger, this is heresy. You are attacking the very foundation of modern America, the God-given right of every CEO to be overpaid. Seriously, though.
Imagine that.
Since the financial crisis, the question has been raised time and again, is there something wrong with American capitalism? You say there is.
Yeah, I think there is. And it started in 1976 when we said the way to align the interests of shareholders and management is with stock-based compensation. And I guess
stock-based compensation is what's wrong with American capitalism? Stock-based compensation, as you well know, is what everybody on Wall Street and in every publicly traded company in America celebrates as the best way to align people's interests, to align executive interests with those of their shareholders. Why doesn't it work?
It doesn't work because what it gives an incentive for is for executives to increase expectations about future performance rather than actually work on future performance.
So you'll have to explain that in a bit more detail for everybody, because what's wrong with raising expectations?
Because what you can do is manipulate expectations, and expectations have no bounds. So if all the people who are investing in the stock market think a company is going to do wonderfully, it'll keep the stock price going up until expectations are far in excess of reality. And at that point, the management team can't do anything
so the stock
increase
collapses?
So the stock typically collapses.
Give us a couple of examples.
Sure. Well, Google recently had its first quarter earnings release. Sales were up 27%, net profit was up 17%, and the stock went down. Why? It's because expectations were so high. A company like that can't keep growing at that rate forever, so in due course, you'll have a crash. But if you have a careful, bloody-minded, manipulative CEO, what they'll do is boost expectations as far and as fast as they can, and then get out before the stock drops. The stock drops, you'll hire another CEO at the crashed stock price. They'll run expectations up again, leave, and it goes over and over. So we've had a shortening of CEO's tenure.
Okay, so we can see how it affects individual companies. Why do you say it's a risk to the American economy?
Well, because what it's done is lowered shareholder returns. So if you go back to the starting of stock-based compensation,
76,
which is 76, and ask the question, have shareholders done better or worse since? And if you just look at the S&P 500, if you want, it's gone down. So shareholders are taking greater risk. Volatility has gone up, and returns have gone down.
Getting less for their money in return.
Less for their money than the period before. So what I like to do is, if we're going to have a change in sort of concept or theory, in this case it was align the interests of shareholders and managers with stock-based compensation, you'd want to see how the theory works. And what we've had are more huge meltdowns, 2 huge meltdowns, greater volatility across the period, and 15% lower returns.
The NFL, how on earth does it fit into the picture and your concerns and criticism over stock-based compensation?
Well, it fits in that they have a similar structure to business, if you think about it, and they operate completely in the opposite way. So there's a real game, too, in the NFL. Going out on Sunday and playing a real game for 60 minutes with a real winner and a real loser. It's like the real game of business, producing products, selling them, and earning a real product. But there's an expectations game there, too. Betting on NFL football.
Played out in Las Vegas.
Played out in Las Vegas, right? Where bettors on either side of the game place their bets, and Las Vegas establishes a point spread, which is just like a stock price.
I see. So if the NFL were more like corporate America, people would be performing according to the spread as opposed to trying to win or lose. Is that the point?
That is right. And quarterbacks would have huge compensation based on whether they beat the spread or not. So you'd have a quarterback who's won a game, but won by less than the spread, would come to the post-game press conference all gloomy and sad and say, "I'm very sorry. I know we won the game, but we didn't hit the spread, and this is so tragic. And we're going to restructure the team and trade our players."
That does sound quite absurd, I have to say. However, I have a question about that.
Yep.
Winning or losing an NFL game is a binary outcome.
Yes.
And business isn't really a binary outcome, because a CEO or a company shouldn't be rewarded for increasing profits 1% a year. The comparison of profits is relative, and shareholders should want to own shares of companies that are growing profits the fastest, should they not?
They should, and that's why I think you should compensate CEOs for increasing profits, increasing market share, things involved in the real market, not whether they can increase expectations. I mean, certainly, if you increase real returns, that should hopefully, over the long term, increase expectations and increase the stock price. But the problem is in the short term, right? Look at what we've done in the last 3.5 years. S&P 500 in October 2007 hit its high, dropped to 43% in a year and a half, and is now back up.
What's wrong with that?
Well, it's nice that it's back up, but think about it. The alignment between management and shareholders is not there. Shareholders, right, have over that period of 3.5 years lost 10 or 12% of their money, but all the CEOs
have made money. So in your world, right, CEOs would have lost money or not been paid anything, or how does it work?
I would just have paid them on the basis of real results. Any kind of real results is what you want, because if they are taking care of real results, the shareholders will be fine in the long term. If they're worrying about the share price, they'll be doing things like kind of manipulating it. They don't care, right? If the stock price goes down 20% and they get a new batch of options at the lower price and it returns to where it was before, they're delighted and rich.
And everybody else is outraged. We talk about this quite often.
Yes.
How do you fix the problem?
Well, I really think it's the best thing to do would be to get rid of stock-based compensation entirely. I actually don't think it has value as a compensation mechanism. But if you're going to have it, it would be to make sure that it's held for a long time. In fact, till after retirement. I mean, my poster boy for this is A.G. Lafley, who went to the board and actually insisted.
Are there any companies that do it right quickly?
I'd say the closest would be Berkshire Hathaway, where Warren Buffett holds his shares forever, and so he doesn't worry about short-term movements.
All right, Roger, thanks so much for joining us.